Rates today are very low. Don't need to tell you that. When I was originating here in Boulder, a passbook paid 5.5%. You wouldn't take a 5.5% mortgage today. You know, we've seen them at, right now they're at 4.5%. Wells will do a purchase loan for you at 4.25% today if someone's buying a home. 4.25 is a really, really good interest rate. And it's very volatile. So the Fed announced their QE2, Quantitative Easing 2. Have you all heard of that? So, and everybody has different opinions on whether this is a good idea or a bad idea, but let's just talk about what the attempt is here and how it may influence people's psyche today. So when we were on the precipice in 2008 of total global financial collapse, the Fed came in and said, we are going to buy trillions of dollars of mortgage-backed securities and treasury securities. And the purpose for doing that is driving up demand for those securities, driving interest rates down, and they succeeded. When they did that, we were at about 5.75% to 6% on a 30-year fixed-rate mortgage because nobody wanted mortgages. They started buying mortgage-backed securities. Bam, we drove down into the 5.25. When we were sitting here last year talking, we were right around 5%, and over the course of this year, we're now down at 4.25 to 4.5%. The Fed backed out in March. I told you on this very podium last year that after March, rates are going to go up. You remember I said that? No, you don't remember. You were eating. I said that. You probably said that. We all thought rates were going to go up. And in March, after the Fed backed out, in April, after the Fed backed out. What happened was that the economy was showing such slowness, and they'd done a good enough job of pulling on that lawnmower cord to get the demand for mortgage-backed securities stronger, that we saw rates not only stay low, but ultimately decline, and took us all by surprise. And we have been dealing with in the mortgage industry, a lack of enough capacity to process all of the refinances that have been taking place in the market. We just can't do enough of them, you know. And by the way, if you're unemployed, we're hiring right now, but we haven't seen the same impact on the purchase market, on people buying homes. We had a lot of activity in the area of March, April, and for some strange reason, anybody know why? April 30th, people quit putting homes under contract. We had great home sales closings in June and July, and then it fell off a cliff. And I'll talk a little bit about where that provides you opportunity today, but that was the impact of what happened. The Fed now has come in and said, we're going to buy another $600 billion in treasuries to try to continue to drive long-term mortgage interest rates down. So ahead of the actual action happening, we saw mortgage rates drift down, and we were down in the 4.25%, even 4% range. We were talking about, are we going to have a 3% number in front of a basic mortgage at some point very soon? And the Fed actually came in, started buying, boom, interest rates went up, and we're seeing extraordinary volatility today. We're seeing, we're managing, ups and downs just so that we don't have the market have to suffer from all of the dramatic ups and downs we're seeing in the mortgage market every single day right now. And yesterday was aggressively down in interest rates. Today we're seeing a little bit of upward movement in interest rates. Now, it's not horrible. We went from 4.25 to 4.5%. We'll have to see what happens. The Fed right now is wrestling with the political winds. You're seeing a lot of people saying this isn't necessary. Why are you doing this? You're just driving up U.S. debt and you're going to cause inflation in the future. But the Fed do not underestimate their commitment to prevent the U.S. economy from going into a deflationary cycle, which would be far worse than the alternatives that we're looking at if they're successful with what they do today. So I'm feeling like you're going to see interest rates see the Fed win on this, and you're going to see interest rates stay low. I'll be interested in seeing, Lawrence, what you have to see on that. Regulatory changes that are going to impact you. One, this won't impact your paycheck, but it's going to impact your loan officers' paychecks. They, starting April 1st, will no longer be able to get paid for originating a mortgage based on the characteristics of that mortgage. This is a very good thing for consumers. The mortgage industry has paid based on the amount of revenue that the lender got. They've been paid if I can get a little more, called overage. If I can get paid a little bit more for that mortgage, then I get more income. But it wasn't exactly a consumer-friendly model. And so federal law and federal regulation will require lenders to get paid the same regardless of what mortgage they sell your clients. But it will fundamentally change the way that they operate, because price and comp have been very closely tied together. They're being decoupled. Mortgage brokers are going to struggle with this. We're not quite sure, and those of you that are mortgage brokers in the room, it'll be interesting to understand how you address this issue. The wholesale lenders, basically it's going to look like this. If you sell the borrower a 30-year fixed rate loan at 4.5, you get paid 2 points. If you sell them at 4 3/8, you get paid 2 points. If you sell them at 4 1/4, you get paid 2 points. You sell them at 5%, you get paid 2 points. It doesn't matter. It's always 2 points. Okay? And you can only get paid by either the lender or the consumer. So the mortgage broker is looking at this model and trying to figure out, how do we adapt? Direct lenders like Wells Fargo or mortgage bankers that originate and then sell through a warehouse line have a little less problematic situation. Basically, it's whatever you sell, it's the same comp that you will always get. It should give you a little more confidence in sending your people, as long as the lender is complying with the law. So just make sure that happens, but understand that that dynamic will be happening.